Hello, and welcome to Boni's Life, the channel where we dissect the complexities of the financial world and empower you with the knowledge to navigate it. Today, we are tackling one of the most transformative financial developments of our time, the rise of the cryptocurrency exchange traded fund, or ETF. For years, the idea of a spot crypto ETF was the holy grail for the digital asset industry, a regulated, accessible bridge for the vast ocean of institutional capital to flow into the burgeoning world of cryptocurrencies. In 2024, that grail was found, first with Bitcoin and then with Ethereum. The floodgates didn't just open, they were blown off their hinges. In this special episode, we will conduct a deep and thorough analysis of how these pioneering ETFs have performed since their historic approvals. We will dissect the timeline, the triumphs, the turbulence, and the tectonic shifts they have caused in the market. We will then turn our gaze to the horizon, forecasting the next wave of crypto ETFs for assets like Solana and XRP that are poised to make landfall. And most importantly, I will equip you with a sophisticated playbook, how to analyze the fundamental market conditions, identify the critical technical trigger points, and strategically position yourself to capitalize on these monumental events. This is not just about understanding the news, it's about preempting it. So get ready to elevate your understanding and refine your strategy. The crypto ETF gold rush is here, and we are about to draw the map. Let's begin with the watershed moment that started it all, the approval of the first spot Bitcoin ETFs in the United States. This wasn't a sudden decision. It was the culmination of a grueling decade-long battle with regulators, giants of the asset management world from BlackRock to Fidelity, threw their weight behind applications only to be met with repeated denials from the Securities and Exchange Commission, the SEC. The primary concerns were always market manipulation, custody, and investor protection. The journey began as early as 2013, when the Winklevoss twins first filed for a Bitcoin ETF. Year after year, application after application was rejected. The SEC cited concerns about the underlying Bitcoin market's susceptibility to manipulation, the lack of surveillance sharing agreements with significant Bitcoin trading platforms, and questions about custody and operational security. Each rejection was a setback, but it also refined the approach. Asset managers learned from each denial, addressing the SEC's concerns with increasingly sophisticated proposals. However, the dynamic shifted decisively after a court ruled in 2023 that the SEC's rejection of Grayscale's application to convert its Bitcoin trust, GBTC, into a spot ETF was arbitrary and capricious. The legal ground had crumbled beneath the SEC's position. The Commission was left with little choice but to re-evaluate its stance. On January 10, 2024, the dam broke. The SEC approved 11 spot Bitcoin ETFs simultaneously, a landmark decision that sent shockwaves through the global financial ecosystem. Trading commenced the very next day, on January 11, 2024. The market's reaction was immediate and electrifying. We witnessed an unprecedented surge in trading volume and a torrent of capital inflows. Let's look at the data. The iShares Bitcoin Trust, IBIT, managed by the world's largest asset manager BlackRock, has been the undisputed heavyweight champion. As of our latest data, IBIT has amassed a staggering $84 billion in assets under management. This represents the lion's share of the market, a testament to the power of BlackRock's distribution network and the trust it commands among institutional clients. Following behind is Fidelity's Wise Origin Bitcoin Fund, FBTC, with a formidable $22 billion in assets. What's fascinating about these figures is the velocity of the inflows. In the first few months of trading, these funds were absorbing hundreds of millions, sometimes billions, of dollars per day. This was not retail speculation. This was a coordinated, institutional-led allocation to a new asset class, facilitated by a familiar and trusted investment vehicle. We can see a clear hierarchy in the Bitcoin ETF space. While IBIT and FBTC have captured the top spots, other players like Grayscale's converted GBTC, RK21 shares as RKB, and Bitwise's BITB have also attracted significant assets, collectively pushing the total assets in spot Bitcoin ETFs well over the $150 billion mark in less than a year. This is, without exaggeration, one of the most successful product launches in the history of finance. However, the story wasn't one of uniform growth. The initial days were marked by a significant market event known as the Grayscale Exodus. For years, Grayscale's GBTC was one of the only ways for investors to gain Bitcoin exposure in a traditional brokerage account, but it traded as a closed-end fund, often at a significant premium or, in the year leading up to the ETF conversion, a steep discount to its net asset value. Upon conversion to an ETF, the doors were opened for early investors who had bought in at a discount to finally exit at par. This led to billions of dollars in outflows from GBTC in the initial weeks. Many analysts initially misinterpreted this as a bearish signal, but it was in fact a structural rebalancing. The capital leaving GBTC was, for the most part, rotating into the newer, lower-fee ETFs like EBIT and FBTC. The net flow into the Bitcoin ETF ecosystem as a whole remained overwhelmingly positive. The performance has been equally compelling. Most of the major spot Bitcoin ETFs have delivered year-to-date returns in the range of 21 to 23%, closely tracking the underlying price of Bitcoin. This demonstrates their effectiveness in providing direct exposure to the asset, which was precisely their stated goal. The convenience of buying Bitcoin through a ticker symbol in a brokerage account, without the complexities of self-custody or dealing with crypto exchanges, has proven to be a powerful catalyst for adoption. The institutional adoption story is particularly compelling. We've seen pension funds, university endowments, and corporate treasuries begin to allocate to Bitcoin through these ETFs. The State of Wisconsin Investment Board, for example, disclosed significant holdings in Bitcoin ETFs. This represents a fundamental shift in how traditional institutions view cryptocurrency, from a speculative asset to a legitimate portfolio component. Just as the market was digesting the impact of the Bitcoin ETFs, the next chapter was already being written. The focus shifted to the second largest cryptocurrency, Ethereum. The logic was simple. If Bitcoin, a proof-of-work commodity, could have a spot ETF, why not Ethereum, the backbone of decentralized finance and the digital economy? The path to an Ethereum ETF was, however, fraught with its own unique set of regulatory hurdles. The SEC had previously hinted that Ethereum's proof-of-stake model and the associated staking yields could classify it as a security. This created a cloud of uncertainty. The transition from proof-of-work to proof-of-stake in September 2022, known as the merge, had fundamentally changed Ethereum's operational model. Validators now earn rewards for staking their ETH, which some argued resembled dividend payments from securities. Yet the overwhelming success of the Bitcoin ETFs, coupled with mounting pressure from asset managers, forced the SEC's hand once again. In a surprise move, on July 22, 2024, the SEC gave the green light for spot Ethereum ETFs, and trading began on July 23rd. The approval came with a notable caveat. The ETFs would not include staking rewards, addressing the SEC's security concerns by treating Ethereum purely as a commodity. The launch of the Ethereum ETFs, while successful, painted a different picture compared to their Bitcoin counterparts. The initial inflows were more measured. The iShares Ethereum Trust, ETHA, has emerged as the leader with over $15 billion in assets, a very respectable figure, but not the explosive launch we saw with IBIT. Grayscale's Ethereum Trust, ETHE, and Fidelity's FETH have also gathered significant assets. Why the difference? A few factors are at play. First, the narrative around Ethereum is more complex than Bitcoin's straightforward digital gold story. Ethereum is a productive asset, a platform for applications which requires a deeper level of understanding from traditional investors. Second, the market had already priced in a high probability of approval, leading to a less dramatic immediate reaction. Third, some of the initial institutional demand for crypto exposure had already been satisfied by the Bitcoin ETFs. Nonetheless, the Ethereum ETFs have been a resounding success, with most delivering impressive year-to-date returns of over 25%, even outperforming their Bitcoin peers in this timeframe. The Ethereum ETF launch also highlighted the growing sophistication of the crypto ETF market. Unlike the Bitcoin ETFs, which were relatively straightforward in their structure, the Ethereum ETFs had to navigate more complex technical considerations. The exclusion of staking rewards while addressing regulatory concerns also meant that these ETFs would underperform direct Ethereum holdings by the amount of staking yield foregone, typically 3 to 4% annually. This brings us to the present day and to the most exciting part of our analysis: what comes next. The successful launches of the Bitcoin and Ethereum ETFs have not just created new products, they have created a new paradigm. The regulatory pathway has been cleared, and the market is now bracing for a boom in altcoin ETFs. The game changer came in late September 2025, when the SEC approved generic listing standards for spot crypto ETFs. This is a highly significant, if somewhat technical, development. In essence, it means that future crypto ETFs that meet a set of predefined criteria will no longer require a lengthy, bespoke, case-by-case approval process. The review timeline could be slashed from over 240 days to as little as 75. This is the SEC laying down a regulatory highway for crypto ETFs. The generic listing standards represent a maturation of the regulatory framework. Rather than treating each crypto ETF as a novel experiment, the SEC has established clear criteria that, once met, provide a streamlined path to approval. These criteria include requirements for market surveillance, custody arrangements, liquidity provisions, and operational safeguards. For crypto assets that can demonstrate compliance with these standards, the approval process becomes significantly more predictable and efficient. And the first vehicles to speed down this highway are already revving their engines. All eyes are on Solana, SOL, XRP, and Litecoin, LTC. Bloomberg's top ETF analysts have gone on record stating that the approval odds for these assets are now virtually 100%. The question is no longer if, but when. And the answer appears to be very soon. For Solana, multiple issuers have their applications locked and loaded. The final S1 amendments have been filed, which is typically the last step before a launch. The market consensus, supported by insider analysis, points to an approval window between October 6th and 10th, 2025. That's just days away. The potential for a Solana ETF is immense. Solana has established itself as a high-performance blockchain, a genuine competitor to Ethereum, with a vibrant ecosystem of applications and a passionate community. An ETF would grant it a seal of institutional legitimacy and unlock a torrent of new capital. Solana's technical advantages are compelling, with transaction speeds that dwarf Ethereum's and fees that are a fraction of the cost. Solana has attracted a new generation of developers and users. The ecosystem includes everything from decentralized exchanges to NFT marketplaces to gaming platforms. Major brands and institutions have begun building on Solana, recognizing its potential as a scalable blockchain platform. Similarly, the XRP community has been eagerly awaiting an ETF. Despite its past legal battles with the SEC, XRP has a clear legal status as a non-security, and multiple ETF applications are pending. Analysts are forecasting an approval by mid-October, with some pointing to October 18th as a potential catalyst date. An XRP ETF would be a monumental step for its adoption, particularly in the cross-border payments and settlement industry. XRP's use case in international payments is particularly compelling. Major financial institutions, including banks and payment processors, have been testing and implementing XRP-based solutions for cross-border transactions. The speed and cost advantages over traditional SWIFT transfers are substantial, with XRP transactions settling in seconds rather than days and at a fraction of the cost. Litecoin, often called the silver to Bitcoin's gold, also has strong prospects for ETF approval. As one of the oldest and most established cryptocurrencies, Litecoin has a long track record of stability and security. Its proof-of-work consensus mechanism mirrors Bitcoin's, which should ease regulatory concerns. This is the new frontier. We are about to witness the ETFization of the crypto space, where a diverse range of digital assets become accessible to the mainstream investment world. This brings us to the most critical question. How do we, as intelligent investors and traders, position ourselves for this paradigm shift. This requires a multi-layered approach, blending fundamental analysis, technical precision, and strategic execution. First, let's talk about the fundamental market conditions. The backdrop for these developments is an increasingly favorable regulatory environment. The SEC, under its current leadership, has shifted from an adversarial to a more pragmatic stance, recognizing that these products are in high demand and that it is better to regulate them than to push investors towards unregulated offshore alternatives. The precedent set by the Bitcoin and Ethereum ETFs has created a clear framework, reducing the regulatory risk for new applicants. The regulatory evolution has been remarkable. From the early days of outright hostility towards cryptocurrency, we've seen a gradual acceptance and eventual embrace of regulated crypto products. This shift reflects not just changing attitudes, but also the growing sophistication of the crypto industry and its ability to meet traditional financial regulatory standards. Simultaneously, we are seeing a powerful wave of institutional demand. It's no longer just hedge funds and family offices. We are talking about pension funds, endowments, and corporate treasuries beginning to make strategic allocations to digital assets. The ETF is the perfect vehicle for them. It solves the custody problem, it simplifies compliance, and it fits neatly into their existing portfolio management systems. This institutional demand is the bedrock of the current market structure and provides a strong tailwind for the entire crypto ecosystem. The institutional adoption story is accelerating. Major corporations like Tesla, MicroStrategy, and Square have added Bitcoin to their balance sheets. Pension funds are beginning to explore crypto allocations. University endowments, traditionally conservative in their approach, are starting to include digital assets in their portfolios. This represents a fundamental shift in how institutional investors view cryptocurrency. Now, let's drill down into the technicals and the trigger points. History provides us with a valuable guide here. If we analyze the price action of Bitcoin and Ethereum in the weeks leading up to their ETF approvals, a clear pattern emerges. Typically, we see a significant price appreciation, often in the range of 15 to 30%, in the 2 to 4 weeks preceding the announcement. This is the buy the rumor phase, where astute traders begin to position themselves in anticipation of the event. The pattern is remarkably consistent. In the case of Bitcoin, we saw steady accumulation beginning in late December 2023, with prices rising from around $42,000 to over $48,000 by the time of approval. Similarly, Ethereum experienced significant appreciation in the weeks leading up to its ETF approval, rising from approximately $3,200 to over $3,800. Volume is your best friend here. Watch for a sustained increase in trading volume on the spot markets for assets like Solana and XRP. This is a leading indicator that smart money is accumulating positions. Another key trigger to monitor is the news flow from the SEC itself. The filing of S1 amendments, as we've seen with the Solana applications, is a major bullish signal. It indicates that the issuer and the regulator are in the final stages of negotiation. You should also pay close attention to the options market. Unusual activity, such as a large volume of call option purchases, can signal that institutional players are making leveraged bets on an imminent approval. The options market often provides early signals of institutional positioning. Large block trades, unusual open interest patterns, and significant changes in implied volatility can all indicate that sophisticated investors are positioning for major price movements. These signals often precede public announcements by days or even weeks. So, how do you translate this analysis into an actionable trading strategy? Let's build the playbook. The first strategy is preemption, or front-running the announcement. Based on historical patterns, a prudent approach would be to begin dollar-cost averaging DCA into a position 4 to 6 weeks before the expected approval date. For Solana, that window may have already started. For XRP, it's right now. DCA allows you to build a position over time, reducing the risk of buying the absolute top. Your position sizing must be disciplined. The periods around ETF announcements are characterized by extreme volatility. It's not uncommon to see wild price swings of 20 to 40%. Therefore, you should only allocate a portion of your capital that you are comfortable seeing fluctuate significantly. Risk management is not just a suggestion, it is a requirement for survival. A prudent approach might involve allocating no more than 5 to 10% of your total portfolio to these pre-approval plays. Within that allocation, you might further diversify across multiple assets, perhaps 3 to 4% in Solana, 2 to 3% in XRP, and 1 to 2% in Litecoin. This diversification helps manage the risk that any single approval might be delayed or denied. Now, what about the event itself? The classic trading adage is buy the rumor, sell the news, and indeed, we often see a short-term price correction immediately following the official approval. This is because the traders who bought in early are now taking profits. This sell the news reaction can be a golden opportunity for the patient investor. It allows you to add to your position at a lower price after the initial hype has subsided. The sell the news phenomenon was clearly visible with both Bitcoin and Ethereum ETF launches. Bitcoin experienced a brief correction of about 10 to 15% in the days following the ETF approval before resuming its upward trajectory. Ethereum saw a similar pattern, with initial profit-taking followed by renewed accumulation. Your entry strategy for this phase should be based on technical levels. Look for the price to pull back to key support levels, such as a previous resistance level or a major moving average. This is where you can deploy the capital you held in reserve. You can use a combination of spot exposure to the underlying asset and, once they are trading, the ETFs themselves to build your long-term position. Technical analysis becomes crucial during these volatile periods. Key levels to watch include the 50-day and 200-day moving averages, previous resistance levels that might now act as support, and Fibonacci retracement levels from recent moves. These technical levels often provide reliable entry points during post-approval corrections. It is crucial to have a long-term perspective. The initial launch of an ETF is just the beginning of the story. The real sustained price appreciation comes from the steady, relentless inflows of institutional capital over the subsequent months and years. The Bitcoin ETF launch was not a one-day event. It was the starting gun for a multi-year marathon of capital allocation. The same will be true for Solana, XRP, and the many other assets that will follow. The long-term impact of ETF approvals extends far beyond the initial price movements. ETFs provide a bridge for traditional investors to access crypto markets, potentially unlocking trillions of dollars in institutional capital. As these products mature and gain acceptance, we can expect to see sustained long-term capital flows that dwarf the initial launch volumes. Looking ahead, the pipeline of potential crypto ETFs is extensive. Beyond Solana, XRP, and Litecoin, we can expect to see applications for ETFs covering assets like Cardano, Polygon, Avalanche, and many others. The generic listing standards have created a clear pathway for any cryptocurrency that can meet the regulatory requirements. The implications for portfolio construction are profound. Traditional asset allocation models, which have long relied on stocks, bonds, and commodities, will need to evolve to incorporate digital assets. The correlation patterns between crypto and traditional assets, the volatility characteristics, and the return profiles all suggest that cryptocurrencies can play a valuable role in diversified portfolios. For individual investors, the proliferation of crypto ETFs represents both an opportunity and a challenge. The opportunity lies in gaining exposure to a new asset class with significant growth potential through familiar, regulated investment vehicles. The challenge lies in understanding the unique characteristics of each cryptocurrency and making informed allocation decisions. Risk management remains paramount. While the potential returns from crypto investments can be substantial, so too can the losses. Proper position sizing, diversification, and a clear understanding of your risk tolerance are essential. The volatility of crypto markets means that even well-researched investments can experience significant short-term fluctuations. In conclusion, we are living through a period of profound transformation in the financial markets. The convergence of cryptocurrency and traditional finance, embodied by the spot ETF, is unlocking trillions of dollars in potential investment capital. We have analyzed the historic performance of the Bitcoin and Ethereum ETFs, and they have proven to be an overwhelming success. driving adoption and delivering strong returns. We have looked to the future and seen the imminent arrival of a new wave of ETFs for assets like Solana and XRP, a wave that is being accelerated by a more favorable regulatory landscape. And we have constructed a detailed trading playbook grounded in fundamental analysis and technical precision to help you navigate this exciting new era. The key is to be informed, to be strategic, and to be disciplined. Understand the macro trends, identify the specific triggers, and execute your plan with patience and conviction. The crypto ETF gold rush is not a fleeting moment. It is the dawn of a new age for digital assets. The opportunities will be immense, but they will favor the prepared mind. As we wrap up today's analysis, remember that the crypto ETF revolution is just beginning. The successful launches of Bitcoin and Ethereum ETFs have proven that there is massive institutional demand for regulated crypto exposure. The upcoming approvals of Solana, XRP, and other altcoin ETFs will further expand this market, potentially creating one of the largest wealth creation opportunities of our generation. Stay vigilant, stay informed, and most importantly, stay disciplined in your approach. The markets will test your resolve with their volatility, but those who maintain a long-term perspective and stick to their strategic plan will be best positioned to benefit from this historic transformation. Thank you for joining me on Boni's Life. I trust this analysis has provided you with the clarity and the strategic edge you need. Don't forget to subscribe and hit the notification bell so you don't miss our future deep dives. Until next time, trade smart and stay ahead of the curve.